Welcome to Global Money Talk, brought to you by SamPro-TV. Greetings to all our viewers from across the United States, Korea, and around the world. We're coming to you live from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm your host, Hai Wang, and today I'm delighted to have Shelby McFaddin, investment analyst at Motley Fool Asset Management, joining us. Shelby, welcome to the show.
Thanks for having me. Great to be here.
Oh, lovely to have you. And just wanted to get started by asking you, can you give us an introduction to Motley Fool and Motley Fool Asset Management? I mean, I was a subscriber, but I think a lot of our viewers might not know who that is.
Yeah,
who
absolutely.
you are, I should say.
Absolutely. So I think the Motley Fool name is very familiar. Our sort of parent or sister company is the traditional publishing business where they go ahead and share different recommendations for investors to sort of take charge and be able to make those decisions on their own. And then around the time of the GFC, our business came to life when a lot of those subscribers said, I need help. I'm really into active management, but I would love if you would do it for me. And so that's when Motley Fool Asset Management was born. And so today, over a decade later, we have 6 ETFs. 3 of those are what we would consider passive, where they are active against the S&P, but they're based off of these indices that the traditional Motley Fool publishing business creates, and then we administer those funds. One of those is the Motley Fool 100, and that's the TMFC ticker, and that's been sort of our pride and joy as of late. It's been very popular. It's our sort of passive large cap growth product, and then the other 3 are genuinely active from our point of view, where they are concentrated, 20 to 30 holdings. We are selecting them individually. We're in charge of all of the allocation, and those we have a Global Opportunities Fund, TMFG. We have TMFM, that's our mid cap fund, and then we also have TMFS, which is our small cap fund. So 6 in total, and 3 where we're really putting in all of the elbow grease, selecting those stocks and managing the entire portfolios. And then we also have our model portfolios, which span from large cap core, large cap dividend, different solutions for wealth management clients.
That's great. I mean, I only knew the newsletter. I had no idea that there was a big asset management piece behind it, including the ETFs.
Absolutely.
So we might come back to the ETFs in a little bit, but I just want to get your thoughts on, we get a mix of of economic data recently. One thing, that the CPI was actually very well behaved last week, and then PPI comes and gives us a little bit of a hot reading. And just before the show, we were talking about trueflation, which has seen sort of a pop in the past month or two. Do you have any thoughts on some of these mixed indicators, and do you have any favorite indicators that you watch sort of over time that give you certain signals?
Yeah, I think at this point, the mix, there's a lot of things we could attribute it to. I think one is just the sort of optimism that went ahead and came out after that first rate cut. And it was a significant sized cut, after all of the holding, after some of the really large hikes in the early days of the cycle. So I think that got the market excited. There was a lot more things that you could be doing. You could think differently about labor. You could think differently about pricing. And then the sort of mixing of it all, I think, is not much of a surprise to us. We've seen this happen before, where you kind of take a pair of months and you get data that starts to conflict, right? So on the one hand, we're excited to see that the economy is not crashing down, right? That's not something that we want to see. We've all been rooting for this soft landing. But on the other end, we say, well, if things are still kind of warm, they're a little bit more than lukewarm, a little bit more than comfortable, then what does that mean for rates? What does it mean for those looking to refinance their homes? What does it mean for those looking to make other larger discretionary purchases that they would normally need to finance? So I think it kind of just sets the market on a wait and see, because that's really how it's been when it comes to all of the interest rate influencing policy. As a team, we don't necessarily follow any one particular indicator too closely, but right now we're definitely keeping our eyes on long bond yields, because that's really what's going to tell us what a lot of the market thinks. So we can look at the Fed, and the Fed can say, oh, we're data dependent, right? They've been saying that for 2 years, and we believe them. But even with inflation getting a little bit better, if the bond market and the mortgage rate market are telling us, no thanks, we're going to stay put around 4.4, no thanks, we're going to stay put around 7.5, makes us think a little bit longer about getting certain exposures and how we want to allocate in the portfolio.
So right now, when you say long bonds, is that the 10-year, the 20, or the 30? The 10-year. So the benchmark. What's that? I mean, we're sort of at recent, I suppose, not far from recent highs in yields, but it's really not climbing any further. What is that telling you specifically, that 10s right now where they are?
I think at this point, the lack of continued momentum upward is saying that the market feels like they have enough information. And that information is that things aren't quite as cool as we want them to be. So I think not seeing as much climbing is saying we're not worried, but we're not optimistic quite yet. So seeing that kind of level out says, let's take a moment, let's recalibrate our expectations for conditions getting a lot easier, but not necessarily saying, you know what, we're concerned. And I think when it comes to mortgage rates, it's reflecting something similar, that when we look at the state of consumer credit, not bad, could be better. The lower end is still maybe finding its bottom. The middle to upper end doing okay. So I think to me it's basically saying we're in a holding period, or rather the bond market believes we're in more of a holding period than a progression period.
So this is a question that I always think about, and I know a lot of our viewers think about, is there are times when I suppose you should look at it from maybe a macro view down. Do you let bond yields and overall market and sentiment drive your decisions, or is it more of the fundamentals of the specific names? And sometimes it's more macro, sometimes it's more micro, I suppose, for the lack of a better term. Where do you think we are now, and what generally do you think is the best approach?
Yeah, on our team, we're definitely bottom-up fundamentalists through and through. And throughout the cycle, whether it was the top of the hiking cycle or the worst of inflation, we are always going to look from the bottom up, because that's how we find these businesses that fare better in these dire straits, where they are going to be the last to sink. They might not sink at all. They're just kind of at a point where it's taken on a little bit of water, but they're able to sort of shovel it out. And you find that by going from the bottom. Now, when we start to consider the macro is when we're doing a lot of our modeling and our allocating. So if we're looking at, say, a small cap, which we were chatting about before, we're going to discount those probably at a higher rate than we would a large cap mature company for a given industry, right? And so when we think about the rate environment, while the investment thesis is not going to hinge on rates being cut, our outlook for 3 or 5 years, there might be something to consider there, because let's say that they still have a decent amount of debt, and part of the what's the word I'm looking for? Part of the earnings story was them being able to pay down some debt. Well, if their debt service is really affecting them, but debt is how they've been growing the business, well, then we have to kind of recalibrate a little bit in a way that's a little bit more difficult to know for sure in each line item. And so you adjust that uncertainty with your multiples and by adjusting your discount rates. So that's the closest to a top-down approach that we would have. And maybe I guess the next sort of degree of that would be saying, let's have a portfolio meeting about the state of industrials. Let's have a portfolio meeting about the state of advertising. Not necessarily because of a 50 basis point change, but how much longer do we think this is going to go? Because if it's going to continue to affect consumers, then it's going to continue to affect advertising. So where are our exposures there, and how do we feel about it? That's how I would say we incorporate the macro.
So, got it. And we're approaching the holiday season here, and I was switching gears a little bit. And we have an economy where I think the consumer probably spends $20 trillion a year. That's trillion with a T.
Yes.
And in services and goods, personal income and spending is one of my favorites. How does the consumer look to you right now going into this slightly shorter holiday season, because Thanksgiving is so late? And any indications whether this is going to be a robust holiday season, or maybe something a little more restrained?
And look, I get this might be a little bit controversial, but I think on the staple side of things, the consumer looks better than it would appear. They are hanging in there, and that's not the way that everyone wants to be described, right? We don't enjoy hanging in there, right? Those who are still kind of living on a check-to-check system, that's not great. They don't enjoy being described as hanging in there. But we have been in a worse situation before, and so I think when we take that top view and we look at the numbers, they're doing okay. When we look at people, when we look at the situations, I think there's a little bit more discontent than the numbers would suggest. There's a little bit more concern. There's a lot more uncertainty, and it's because that savings are being eaten away. Now, the one thing about Americans is we make Christmas happen. I say this every year. We see the spending. It pops up every time. But what we're looking at as active managers is what's going on before and after, right? And that's what the retailers tend to look at as well. That real barometer is how are they spending in October and how are they spending in February, March, right? So I think at this point, how they're feeling will be probably smaller purchases. If someone is buying a washer and a dryer, it's more likely that it's more of a staple and less of a discretionary, and that they waited for a discount to work to their advantage. Probably going to see less autos purchased. Anything that needs to be financed, probably going to see that coming down a good amount. And other just really large discretionary purchases that, you know, if you were buying that that expensive vacuum, you might not be doing it unless you really, really need to. I would also expect that we're probably going to see a lot more buy now, pay later. So when we get those sort of week-by-week reports, probably seeing a little bit more of that. And given the fact that it is a shorter season, the online ordering might be less. So we'd have to kind of adjust the buy now, pay later to that as well, because it's traditionally available in online portals. Some in-person locations are doing it, but not as many as online. So I think we'll see a little bit more of that adjust for the shorter shipping season. But on the whole, I don't expect a huge drop-off, probably flattish.
You mentioned something about sort of the week-by-week reports, and you know, I'm just used to the monthlies. Is that very specialized? Is it paid portals only, or are there anything like, you know, sort of generally available that you can see, you know, week by week? Yeah,
oftentimes they will come through Spending Pulse, which I believe is through a MasterCard product, and then a lot of times it's something that we'll just kind of see in like the Cap IQ Newswire, where you'll have different retailers reporting like how Cyber Week went, how their Black Friday weekend sales went. A lot of those times they'll just come through major reporters. I'm sure there are absolutely more detailed paid reports, but oftentimes we're fortunate enough to just sort of get them through the research houses and the major banks that publish them. So those little infographics that you see come out, things like that. And so typically those will start flowing through after the first weekend of shopping, where they'll say, okay, we're down compared to last year, or compared to 2 years ago, or we're at 2019 levels. It's not enough to fill a spreadsheet, but it's enough to give you a pulse on how is this going. So usually we can get an idea on how the season went, but by Christmas, as opposed to having to wait for the January 31 retailers to close out their quarter.
So how closely do the retailers, that's a dumb question, but like, do they watch it? How much do they react to the ongoing data? If they see that there's a week of data it looks soft, do you think they actually move and do more discounting into the season? Do they react very quickly to the incoming data?
Based on calls coming out of the holiday season, the broad answer would be no. And mainly because they've done a lot of their ordering already. There's not as much that they can do, and when you make those snap decisions as well, you don't get a lot of time to determine how that's going to affect the bottom line, right? So a lot of the decisions that they've made, the planning they've been doing, they did in the beginning of the year. And that ordering, what they have for the season, has been sitting in inventory. Obviously, now we see all the Christmas stuff on the floor, but it had been sitting in inventory maybe since March. So any sort of tweaks, we know that there's dynamic pricing, right? So to the degree that they can tweak something, a small amount, sure. And they might say, well, this week we're doing this, and then they review that, and they say, well, maybe we need to tweak it 5% or 3%, or maybe we need to move around where this is on the display floor. But massive changes are less likely to be happening in the season because the risk is very high to what it's actually going to deliver on the project, and they can't necessarily change what they put out without maybe counting it as a loss. If they realize that something isn't selling very well, they have to ask themselves if they want to pull it off the floor, because is it going to sell next year, or what do you do there?
You know, I remember the first Amazon, I guess, Black whatever Monday that they have.
Oh yeah, their first Cyber Week.
Cyber Week, that's it. And I remember I have 4 kids, and the kids always need something. And we actually waited, until Cyber Week to buy them to see if they would go on sale. And I actually thought that Cyber Week, those discounts were a little disappointing personally. But I never looked at how was that week for Amazon. Did you ever see any reports about that? Did they do well? Or?
At the risk of being wrong and everyone being able to Google it, I want to say it wasn't super remarkable last year. Now, Prime Day was also fine. I don't remember there being a big hullabaloo about how well Prime Day went. I think a lot of people are facing the same thing that you pointed out, is that, wow, I expected this to be a bigger discount. And there was a time where you went to Black Friday and you went in person, and any store you went into, everything was 50% off. Some stores were 70% off. But now you're facing a point where the Black Friday deal is 40%. And it's 40% off of something you really don't need. And you might not want it that much. And it tends to be 40% off of something that was already $3,000. So you maybe weren't going to get it anyway. So you're thinking, oh, great, 40% off of this TV. I've got one. And so the deals, even in staple products, where I used to do things like I would get our electric toothbrushes on Black Friday because they were much more affordable. But a lot of times those things are only 20% off now. So you do have the degree of people that are just waiting to consume at that point, and it's not holiday related at all because it just makes sense, right?
Sure.
But if the deals are getting, weaker, then they'll just say, you know what, I'll break my consumption out over the Memorial Day sale and the Labor Day sale and the Easter sale, because Black Friday is now no different from any of those. And I think as we continue to get to that point, then we would probably see the holiday season boost start to shrink a little bit.
See, any consumer names that you particularly like, at the moment?
Yeah, I would say it may not be differentiated, but we still love Costco. I mean, we've loved Costco forever. Now, do we love the Costco valuation? No, we do not. It eludes me, even as someone who's sat with the spreadsheets, and I just say, how are they coming up with this? But it's a phenomenal business. And I think in general, the wholesale concept is deeply appealing, not just to Americans, but we're seeing with the Sam's Club data that was out, that it's more appealing in an international scale. Costco is still figuring its way out in China and still doing very well. So that's something that we love. Another one, Walmart. Don't love the Walmart valuation, love Walmart. They have an operational leverage machine that is almost unmatched. They can really just move up and down with the state, or rather with the part of the cycle that we're in. And so I really appreciate that about them, and it's a reason why I've sometimes said if we need to trim this for use of funds, that's fine, but you won't see me anytime soon saying, let's get rid of Walmart on fundamentals. Another company that's been interesting to us from a consumer perspective has been Procter & Gamble, and that's a little bit less exciting. It's more of it's a dividend member for us, but they've really shown the value of delivering quality to your customers, and they were able to go through a period where they had a little bit of negative volume, but one thing they've not had to do to deliver to shareholders is chase volume by cutting price. They've been able to continue to innovate, and as a big fan of Kirkland, I don't know what Procter & Gamble's putting in Tide, but it's just different. The actual Tide is something else. It's just different. They've really figured it out. So
Tide is the detergent.
Yeah, just the sense that like whatever R&D that they are doing, there's something that really sticks.
Wow.
They are able to keep people buying it in a way that I think other CPGs sometimes struggle with, especially if they've got more of a healthcare tilt. It's tough to sell Advil over ibuprofen if one is 20% cheaper.
Yes, yeah. We talk about Costco a lot on this show. I was an ex-gold trader, and their gold bars is a really good deal.
It's a fantastic deal.
I don't know. It must be something they negotiated, because it's better than you could find almost anywhere.
I mean, this is the dad joke of the century, but that's why it is called Costco. They get the best cost on everything.
Yeah.
And no competitor has really been able to prove otherwise. And that's what keeps a consumer coming in, is knowing that management cares about you. In a world where we're shareholders, right?
Right.
But that sometimes pins us against a lot of America, where it's the shareholders, right? Costco, I think, finds a really great way to live in between and say, we are here to make this work for you and serve your family, and also maybe get you to buy some sweatpants on your way out, right? But they are trying to move with the prices. They were one of the first retailers to say, we noticed the price of this went down, so we brought the price down. And when people feel like you care about them and you show them that you care about them, they're more likely to bring you their business.
Yeah, absolutely. Moving our focus just a little bit, we're talking about the industrials a little bit earlier, and you're kind of neutral on them right now. Can you expand on that a little bit?
Yeah, so when we look back to the passing of the IIJA and all of that funding that sort of came out, the industrial space got very exciting. This was also pre the sort of hike in interest rates, so it wasn't just free growth for tech companies, it was free growth for industrial expansion as well. Looking at the state of roads and bridges in the U.S. and the state of infrastructure in general, we thought this is a great place for us to be. Now, going into, or rather coming out of the election, there was a sort of thought of, is this still the place to be? And when we had our sort of post-election meeting as a team, we thought, actually, yes. This has been a bipartisan effort. It's something that is deeply necessary. Pulling that sort of funding out of construction jobs is something that is pretty antithetical to how the American economy has run traditionally. So it's something that would get bipartisan fury, frankly. And we realized, you know what, there are players here who are very much settled in. And this is an opportunity that if the price is right, we should continue to dig our feet in further. Something we've done work on in the past was Jacobs, formerly Jacobs Engineering, because they do have their hands in different places, not just the sort of traditional construction work, but also a little bit in defense and also a little bit in making data centers, which we know if the sort of trend of onshoring continues, that's where a lot of these industrials succeed, because the continued growth in demand for data centers, they have to be built. Right, and they can't just be built by anyone. That we know the government doesn't build them themselves, they hire contractors. And so to win these projects, you need to have really proven yourself. And so we find these companies that have done so, and we think it really is a space that you can feel decently comfortable in, especially with a company like CRH, where they really have sort of cornered the market on all sorts of paving projects in the United States. They deliver a fantastic dividend. They know that balance of reinvesting. They are constantly gobbling up businesses, but also being able to shoot capital back out to shareholders, and that is top tier for us.
Great, great. I wanted to actually get back to something we discussed earlier. Americans, I mean, you look at this sort of the ETF business where it's really sort of passive, right?
Yeah.
People stick money into the S&P 500 or in some sectors. But Motley Fool has has three sort of actively managed sort of ETFs. Can you expand a little bit on why active or choosing active management can sometimes be a big advantage, and when you should do that instead of just chucking your money into the S&P 500?
Yeah, absolutely. I mean, I think one of my favorite things to say is that choosing an active ETF is a way to get active without breaking a sweat. You dump your money, you let us run it for you. We're the ones who have to sweat. We do all the work, and you get to enjoy the active return on the market. And I think the advantage to doing that is pretty much that you get to reap the benefits of the inflection point. So when you're passive, you get a temptation to just ride with the market. And unless you have a very long time horizon, there is a temptation to just move in and out with how the market goes. And you might miss things that no one could have predicted because you simply have to move with how the top 7 stocks are moving the market. When you get a bit more active, it means that you sit tight with something as it goes through a little bit of a pain period, but as soon as that management turns around, as soon as that cycle turns around, you're not having to stress about timing when to get back in. You're already there. And so, yes, there can be a little bit more pain. I think the numbers have shown that, you do oftentimes need a much longer time horizon when you want to get active. But if you have that, if you're talking about someone in their 20s or 30s and they're planning for retirement, active management is a great tool. Getting a little bit more active against the S&P, against the broad market, that's the time to do it. When we look at, if you've got a 5-year time horizon, depending on what it is that you're trying to do, well, equities may not even be for you at that point. But if you're insisting on it, then you may say, let's go ahead with market. But I think the real advantage to active is we seek upside capture, but I think oftentimes it's that downside capture that really sort of takes the cake, where picking the better businesses helps you perform better when the entire market is down. And then if you've really stuck to the cream of the crop in the portfolio, you can also outperform when the market is up.
Right, right. I guess the whole idea that it's been a discussion in the markets where just leave your money in and don't mess with it. It's become something of a mantra. So for these ETFs, we'll be able to find performance and other details on the website. Or?
Absolutely, yes. It is all available on fulletfs.com, and you can see the difference between the types of products that we have, where they're the passive, where they're active to the market but passive to us, and then our active, where it's active to us and active to the market. They have all of the performance information, prospectus, holdings that are regularly updated. You can find all that information there.
One thing we talked briefly about small caps and I get mid caps a little bit earlier, but that seems there's different indices. There's the S&P 600 and the Russell 2000. There seems to be a big universe of sort of small caps, and we say that. Can you just talk a little bit about what small caps mean to you and how the investor maybe should approach them?
At Motley Fool Asset Management, small caps are one of our favorite opportunities because you get an opportunity to watch a company grow. You get a chance to sit with them and watch their management be nimble, be opportunistic, and watch their customer base expand, and hopefully they turn into a mid-cap. And maybe they settle out there. You know, you need a few decades oftentimes to see a small cap turn into a mid-cap, turn into a large cap. But that is one of the reasons we really love it. Another reason is that they tend to be providing something that is mission critical, and you don't realize it. You don't realize just how involved it is in a different process. And when you can become a part of that as it continues to expand, you're not having to time it. You're not having to sit and say, oh, I'm having to get in at this multiple because I didn't pursue small caps. And the other thing too is we know that small cap has gotten pretty big. You know, there was a time where it was 5-6 billion. Now we're talking about 13 billion, and depending on who you're talking to, they still might consider it, 20 billion and under, right? So, or at least calling that a mid cap. And I think it's exciting for us because you get to also get much closer with management. We just had a call with one of our small cap names a couple of weeks ago because we've been shareholders for a really long time, and they're definitely going through some sort of restructuring, and we're saying, look, we want to be a part of what's going on here, but our original thesis is broken and you guys got to talk to us. And so I think that's something that, yes, comes with the privilege of being an asset manager. It's not as easy for a shareholder to just call. But from an asset manager's perspective, that's something that we really enjoy is watching these businesses really take off. We've had some med tech businesses that you're with them for a while, they're cruising along, and then they get that one approval and it takes off. And it's done what we needed it to do, and we sell, we're good to go. So it's not like a 1 month turnover, we're not traders, but we are watching and we're being able to say, that's great. We had Shockwave, and so when they got acquired, that was a success story for us. So those are the types of reasons that we're really interested in it. And I think for the average investor, they can be scary, the average retail investor, because they can be really volatile. You tend to not get a lot of information in between quarters. So you're sitting on your hands, waiting for how something is going to do, and you have the earnings call and maybe it's off 20%. So I think you have to take an even longer approach when it comes to smalls, and it needs to be a part of your portfolio where you're not concerned about the state of your losses over a 3-year period. You have to sort of take that allocation approach where you say, of my US equity portfolio, I'm doing 5% small because that's my pain tolerance for if I lose 40%.
It seems like if you want to get into smalls, it might be the right place to have someone active, so or paying more attention to it, with a little more access and a little more information than you might, you're just seeing stuff quarter on quarter. Do you sense that? And this moves into I guess the final little segment of our talk today. For 2025, do you think that we'll get substantially less of the Mag 7 led market and more of a rotation in the smalls and mid caps? And then the follow up to that is what things are you looking at in in an environment that's really pretty volatile? You have one administration coming in that's really antithetical to the previous one with a lot of uncertainty. So I guess first, do you think the rotation is going to happen?
I think the rotation is possible, and I think that depends on inflation coming under control to a large degree, because small caps are very sensitive to interest rates. For some reasons we chatted about before the show, where it's just they need to service that debt a lot of times. There are some small caps that are really well capitalized, and it's not an issue for them. They've been able to grow without taking on large amounts of debt. The other thing is just the risk. If they trade less, and they've just got less capital, people just tend to be a little bit more adverse. So they sometimes get punished for something that they really haven't done. And higher interest rates due to higher inflation tends to punish them for that. So if we can get that under control, I think we might see a little bit more of a rotation. If not, you may still very well see an increase in sector-based breadth coming out, in 2025. But I still think that there would be a lot more interest in being close with those large caps because they just seem very dependable, right? And some of them, like Microsoft, that are actually very mature businesses, they got to ride that sort of AI wave. Apple, mature business, they still got to ride the wave. And those are companies that I don't expect are going to absolutely just crater, simply because inflation didn't go where we expected it to. Some of that premium might come off, but I would sooner expect there to just lose a little bit of a premium, a little bit more rotation into fixed income than necessarily people saying, well, this whole AI thing isn't paying off, let me go to small caps. I think that's a little bit less likely.
Great. Well, thank you so much for coming on the show today. Hope you get an easy trip back to Arlington, Virginia. We hope to see you again sometime soon.
Yeah.
And that will do it for Global Money Talk, live from the New York Stock Exchange. We're so excited to bring you daily coverage here on Sampro TV. You can check out the show anytime on our YouTube channel by searching Global Money Talk. Thank you so much for joining us. We'll be back here tomorrow. Have a great day.